While retail panics, the whales are doing the exact opposite, and the data is undeniable. During one of the sharpest pullbacks this cycle, on-chain analytics tracked 1,389 separate transactions over $100,000, the highest count in months. Over 442 million XRP, worth approximately $592 million, was pulled from major exchanges in a single stretch, moved into cold storage, off the order books, out of the tradable supply, permanently as far as short-term markets are concerned. And while those hundreds of millions of tokens were being absorbed by large holders, retail was doom posting, selling at the lows, calling XRP dead, providing the exact exit liquidity that the whales were designed to consume. This is the divergence that defines this moment. The people with the most capital and the longest time horizons are buying aggressively during the dip. The people with the least capital and the shortest time horizons are selling. And every token that transfers from the second group to the first never comes back to market at these prices. This is not financial advice. I am sharing publicly available information for educational purposes. Always do your own research. Before we get into it, drop divergence in the comments if you see the gap between what whales are doing and what retail is feeling. Drop accumulating if you've been buying alongside the smart money during this pullback. Drop holding if you're not adding but you're not selling either. I want to see the real split in this community. Welcome back. I am the Calm Analyst. Around here we follow what the money is doing, not what the sentiment is feeling. Today we're breaking down the whale accumulation data, the ETF supply absorption, the RLUSD flywheel effect, and why the supply-demand setup being created right now is the most asymmetric opportunity this community has ever faced. Let's get into it. Let me start with the on-chain data, because numbers don't lie, and the numbers are screaming. 1,389 transactions over $100,000 during the dip. That is strategic, institutional-grade buying, not retail dollar-cost averaging. Whale inflows have averaged significant daily positives since late February. In one volatility spike, 120 million tokens moved in under an hour. 442 million tokens pulled from exchanges into cold storage. Every token pulled from an exchange is a token no longer available for immediate selling. When exchange balances decline while large holder wallets grow, the interpretation is unambiguous: accumulation, not distribution. And here's the psychological dimension that most people miss. Whales don't buy during dips because they enjoy the pain of watching their portfolios decline further. They buy during dips because they've run the math on what happens when the catalysts land and the supply isn't there to absorb the demand. They're not reacting to the dip, they're positioning for what comes after it. And the divergence between their behavior and retail sentiment is the clearest signal available about which group has a better model. If that divergence just reframed how you think about the current dip, smash that like button, because the people panicking are providing exit liquidity to the people positioning, and understanding which side you're on is the most important decision you make in this market. Now let me connect the ETF data, because the supply absorption is happening through two separate channels simultaneously. Spot XRP ETF products have seen steady net inflows in recent weeks. Cumulative assets under management climbing past the $1.44 billion mark, with additional growth continuing. Data shows weeks with nearly $19 million flowing in, absorbing supply, and creating a floor effect that whales are reinforcing on-chain. And here's the critical mechanic that most people don't understand. ETFs require custodians to hold actual XRP in cold storage. When an institutional investor buys shares of an XRP ETF, the fund goes out and purchases real XRP tokens and locks them in institutional-grade custody. Those tokens do not return to market until the shares are redeemed. They're gone from the tradable supply. So you have two absorption mechanisms operating simultaneously. Whales pulling hundreds of millions of XRP off exchanges into personal cold storage, and ETFs purchasing XRP and locking it in custodial vaults for institutional investors. Both reduce the available float. Both are happening during a dip while retail is selling. Exchange balances have hit multi-year lows. Fewer tokens available for immediate selling, while demand from both whale wallets and ETF products grows. This is the supply shock setup, not theoretical, documented on-chain, measurable through ETF flow data, and invisible to anyone only watching the price chart. Comment below, are you tracking exchange balance data? Type tracking if you monitor the declining float. Type price only if you've been focused solely on the chart, because the exchange balance trend tells you more about what's coming than any candlestick pattern. Now let me connect the RLUSD flywheel, because this is the mechanism that turns stablecoin growth into XRP demand without most people understanding how. RLUSD has grown to approximately $1.35 billion in market cap. Monthly transfer volume is up 149% in the last 30 days, now over $11 billion. Monthly active addresses up 152%. And on the XRP ledger specifically, stablecoin transfer volume is up 109%, over $1.73 billion. Here's why this matters directly for XRP's price. The XRP ledger's auto-bridging feature uses XRP as the default liquidity bridge between all assets on the ledger. When RLUSD transactions execute on the XRP ledger, auto-bridging routes liquidity through XRP behind the scenes. More RLUSD activity means more XRP utilization as the bridge asset. And every transaction on the XRP ledger burns a small amount of XRP in fees. More RLUSD volume means more XRP burned. Supply shrinks while utility demand grows. The interplay between RLUSD and XRP isn't just additive, it's multiplicative. Every new use case for the stablecoin pulls more volume through the ledger. Every transaction uses XRP for bridging. Every bridging transaction burns XRP. The flywheel turns faster as adoption scales. Ripple's institutional corridors are using RLUSD for 24/7 settlement that traditional systems can't match. Banks and corporations accessing these corridors through Ripple Treasury's SWIFT-certified platform generate RLUSD volume. That volume drives XRP demand through auto-bridging, and the XRP demand reduces supply through burns. That's not speculation, that's the mechanical design of the system. And the 149% increase in RLUSD transfer volume in the last 30 days is the flywheel accelerating in real time. Subscribe right now, hit the bell, drop a in the comments. Because the RLUSD flywheel, the whale accumulation, and the ETF absorption are all converging on the same compressed supply. When the catalysts land, Clarity Act, SWIFT corridors going live, institutional mandate updates, the supply available to absorb the demand simply won't be there at current prices. Now let me address the network activity growth, because this is the fundamental layer underneath all the capital flows. The XRP ledger's transaction volumes have expanded notably, not from trading hype, from payments, tokenized assets, and cross-border use cases. Developers and partners who once hesitated are now integrating for tokenized real estate, commodities, and bonds. Ripple's conditional approval for a national trust bank charter has advanced with the OCC's April 1st rule update, expanding the scope for digital asset custody and non-fiduciary activities under federal oversight. Hundreds of global partners are on board. Each new integration funnels more utility through the ledger, and the XRP ledger's security architecture provides what institutions require. No smart contract attack surfaces, no MEV, no front-running, deterministic finality in seconds, protocol-level compliance features. The exact attributes that the Drift Protocol exploit on Solana demonstrated are essential for institutional capital preservation. When you combine the on-chain whale accumulation, the ETF custodial absorption, the RLUSD flywheel, and the network activity growth, the picture is clear. The fundamental demand for XRP is expanding while the available supply is contracting, from multiple directions simultaneously, through mechanisms that reinforce each other. Now let me give you the honest range of where this leads, because the projections need to be grounded in the mechanics we just covered. Analyst consensus for 2026 clusters in the $2 to $8 range under moderate scenarios, driven by ETF demand, network volume, and adoption metrics. Standard Chartered's base case is $2.80, with a bull case of $8 and a 2030 target of $28. More optimistic projections extend higher based on historical patterns and institutional rotation. But the key insight is that all of these projections assume a certain level of supply availability. If the supply compression we're documenting, whale withdrawals, ETF lockups, declining exchange balances, auto-bridging demand, transaction burns, continues at the current pace, the actual price response to institutional demand will be amplified beyond what the standard models predict. Market cap models that divide expected demand by 61 billion circulating supply produce one answer. Models that divide the same demand by an actual free float of 8 to 12 billion tokens produce a very different answer. And the on-chain data shows the free float is compressing toward the lower end of that range every month. XRP's fixed supply of 100 billion tokens, with controlled escrow releases and cumulative transaction burns, creates scarcity that compounds with adoption. Unlike inflationary models, where new issuance dilutes existing holders, XRP's design rewards holders through scarcity dynamics that tighten with every increase in usage. Let me close by addressing the psychology. Because in moments like this, the data matters less than the conviction to act on it. The dip feels real, the red candles feel real, the headlines feel real, and the fear of being wrong feels more powerful than the excitement of being right. That's human nature. But the whale data is also real. 1,389 transactions over $100,000. 442 million tokens moved to cold storage. Exchange balances at multi-year lows. ETF inflows steady while broader crypto funds fluctuate. RLUSD transfer volume up 149%. And every regulatory agency in the United States systematically clearing the path for institutional engagement with digital assets. The people selling right now are selling into the hands of buyers who made $592 million worth of purchases during the exact same dip. Those buyers are not speculating on a 20% bounce. They're positioning for a structural repricing event that the current price does not reflect. Every previous cycle has shown the same pattern: maximum retail fear coinciding with maximum institutional accumulation. The people who understood the divergence and held their position were rewarded. The people who sold at the bottom to escape the pain watched the recovery from the sidelines. This time, the institutional infrastructure is stronger than it's ever been. The regulatory framework is more advanced than it's ever been. The supply compression is more documented than it's ever been. And the whale accumulation during the dip is more aggressive than it's been in months. The divergence between what retail feels and what the data shows is the signal, not the price. Price is a distraction. Value is the reality. Structure is what matters. And the structure being assembled right now, through whale accumulation, ETF absorption, RLUSD flywheel mechanics, regulatory progress, and declining exchange supply, is the most bullish supply-demand setup in XRP's history. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. Comment, "Calm Analyst," below. Let me see who stayed for the complete divergence breakdown. And share this with someone who sold during the dip without checking the whale data. Because the smart money wasn't selling alongside them. The smart money was buying their tokens. Like, subscribe, notifications on. I'll see you in the next one. Stay patient, stay rational, and as we always do, we don't wait for the future. We plan for it. Peace.